Welcome to the Plan Solutions Incorporated podcast, where we give facts and insight on the latest happenings in the world of economics, financial markets, and personal finance. Plan Solutions provides advice on a variety of financial topics, including investment management, tax preparation and planning, and retirement planning. Chase has 25 years of experience in the financial industry, holds a certified financial planner and chartered financial analyst designations, and has earned a master's degree in taxation and a doctorate in business administration. Chase has a passion for helping clients down the path toward their financial goals. And I'm Jason LaChance. And on this episode, we're going to discuss the Federal Reserve's dilemma, what the betting markets tell us about the U.S. economy, American Opportunity Tax Credit, and a look at the Plan Solutions Incorporated Office Bulletin Board. Mr. Armour, how are we, good sir?
Doing well. Other than the computer problems that you and I are both complaining about, I guess technology, it's a blessing and a curse, but we'll figure it out.
Yes, sir. Yes, sir. All right. Well, let's dive right in. The Federal Reserve's dilemma. It's been an interesting time, concerning interest rates, but the Federal Reserve Open Market Committee, as expected, voted unanimously to hold their short-term interest rate target steady in their June meeting. Why is that? What are we seeing? What's happening? And let's dig into the complexities of it. Sometimes people may not understand, and I'm still educating myself on why they choose to either raise or lower the interest rates or keep it steady.
Yeah. The Federal Reserve has a tough job. They basically control the shortest of the short-term interest rates. And what they're trying to do is find the right equilibrium, right? I think a lot of people talk about, the Federal Reserve, chose to do this or chose to do that. But, really, I think if you put yourself in their shoes, it's not really a choice that they're making based on what they want to do or what they'd like to be happening. They're looking at the data and saying, what is the right level for interest rates to best serve the economy? Mm-hmm. Because they really have one tool, and that one tool is powerful. If rates are too low, it could lead to high rates of inflation. If rates are too high, it could lead to slow economic growth and high rates of unemployment, right? So both are bad, and they're kind of offsetting in terms of, kind of pick your poison, right? Which bad do you want? Well, really, in an ideal world, they don't want either. So they want to find that right equilibrium right between where they can keep both inflation and unemployment low. And I think, they've had a challenging job, right? It's Fed's been criticized a little bit for maybe being slow to raise interest rates when inflation was really accelerating a few years ago. And I think probably rightly so. They kept saying that inflation was going to be transitory, short-term thing, and it would reverse. Clearly, that wasn't the case. And then arguably, because they were late, they probably had to increase interest rates more than they otherwise would have needed to. One could argue maybe that's what contributed to the difficult economic and market environment in 2022, right? Maybe it would not have been as bad had the Fed not been behind the curve and having to increase interest rates faster and by more. But more recently, they're on the other side of the dilemma, right? They started cutting their key interest rate target in late 2024. They cut 3 times. So the first cut was 0.5%, followed by 2 more normal cuts of 0.25%. So, a full 1% cut, so that now their target interest rate is between 4.25% and 4.5%. But, things have gotten a little trickier this year. The Fed basically has since paused their interest rates cuts. So they basically held rates steady in 2025, as you mentioned, including in their most recent meeting in June. I think, we bring up the topic because maybe the Fed's getting a little bit more towards a tipping point with what we're seeing in the economic data. And maybe we'll start to see them resume that policy of normalizing rates.
Well, and there's several factors that obviously play into that. It's been an interesting year thus far, and we've talked about it on many of the past episodes. Obviously, with the impact of trade policy going on, government employment. Those are just a few of the factors that go into it? Is there anything that I'm missing out of that? That in addition, sometimes maybe the headline doesn't paint the clearest picture for people.
Yeah, I think you could create a pretty big list of things that the Fed may be concerned about, but I think you hit on the two main ones, right? And they're both kind of pointing in different directions. So, one, you have, the federal government spending and employment policy, right? The cuts within the federal government. There was a lot more talk of that earlier in the year. Obviously, that could have an impact on unemployment. And what a lot of people don't realize is for every federal government employee, there's a lot of contractors out there. And so cuts at the federal government, even if it's not direct employees, it obviously could work its way through to contractors if they're having funding cut. So I think that was a concern of the Fed that we could see unemployment increase and want to keep a strong economy, hopefully, to be able to absorb those jobs if we did see a meaningful reduction in force at the federal government or associated contractors. But then on the other hand, so normally that would maybe cause the Fed to lower interest rates, stimulate the economy, make sure the job market stays strong. But on the other hand, you have the concern over tariffs, and in essence, tariffs are effectively a tax on imported goods. So to the extent that those taxes are passed on to consumers, you would expect prices to increase. Now, obviously, there's a lot of debate about how much of that tax may be passed on. Are there substitutes? Are there other options? I mean, economies are more dynamic than the one-for-one relationship that usually you hear reported, or that it's going to be a one-for-one relationship. It's pretty rare that that's actually the case. But you would expect, higher taxes on goods being imported would, at least to some extent, result in higher prices. Of course, that would bleed through to inflation. So that would argue for the Fed raising rates to try and keep that inflation in check by slowing economic growth. But I think with, these different factors pulling them in two different directions, if we're being charitable, it probably makes sense that the Fed would pause and wait to see if additional information is coming in before they make a shift in interest rate policy. But fast forward, 6 months or 4 months or however you want to look at it to where we are now. I mean, really, we just haven't seen the Fed's concerns materialize. Inflation has continued to trend lower, despite a lot of the uncertainty about the tariffs. The job market has been fairly strong, not blow your doors off strong, but hasn't weakened too much, and the unemployment rate is held steady. So, unless the Fed really believes that some of these changes are coming with a longer lag, that the policy, that it won't really show up into the data for 3 months, 6 months, 9 months, maybe if they're believing it's a longer lag and it'll take 6 to 9 months to factor in. But assuming they're just taking the data at face value, you'd think they'd be getting close to resuming their previous policy of normalizing interest rates by starting to cut again as we get into the second half of the year. It's a really interesting scenario, and as you mentioned, like around tariffs, and we've talked about, there's been a lot of instability around just what the policy would be. We would see a 30-day implementation, then a lax on it, then and so there's been a lot of factors. But you do state that these factors will put even more focus than normal on the Fed's July meeting. Is July not normally a time where this decision is made because it's the start of the third quarter, or what are some of the factors in that where July normally isn't maybe one of the greater focus months for the Fed? Well, it's not that July meeting is different than any other, but you do often see a September meeting as being kind of the period when they'd start to shift for whatever reason, right? We talked about they started lowering interest rates last year, had 3 cuts, started in September with the 0.5% cut. And if you look at a lot of the predictions, they're looking more towards September as being likely point where the Fed may cut interest rates again. But that's been starting to shift. And so I think the data that we're seeing, and that, some of these concerns are not really materializing, is causing some to say, well, maybe we could see a rate cut as soon as July. We've actually had a couple Federal Reserve governors come out and talk about, that they may support the idea of the Fed cutting interest rates in July, which is often a way for the Fed to kind of test the market reaction, right? They get out there and talk and say, this is what we're thinking, and then see how the market may react, whether it thinks they're on the right track or not. And a lot of times they want to, kind of forecast or let people know what their thinking is so it doesn't take the market by surprise. So this may be kind of an early sign that they're really starting to kind of float that trial balloon and see if it's something that the market will go along with, and maybe if they can get other Federal Reserve governors to go along with that view.
Yeah. Does the fact that the summer tends to be a good vacation time for folks, and then of course obviously mentioning September, kind of the precursor to the holiday season, do those come into are those a factor in this? So, if they kind of see July, maybe early August, that there was some good spending in travel, that consumers are not necessarily holding on to their money, so to speak, that plays into it? Or is this just kind of happenstance of how things lay out throughout the year?
Yeah, I mean, part of it is Wall Street finance does tend to have a bit of a cyclical, and it tends to be quieter over the summer. In the market, there's the old saying, sell in May and go away, because typically you don't get a lot of trading volume over the summer. You don't usually get big moves. Of course, as with any Wall Street saying, it, holds in a lot of circumstances, but not all. So you can't take it as gospel. But, it is often that things are a little bit slower, a little bit quieter. You don't get as many big announcements or big changes, for whatever reason. Yeah, maybe it's, people are on vacation, people are, doing other things, or maybe there's some other, cyclical or seasonal factor to it.
Okay. I was just curious about that when you mentioned those particular months. Anything else you want to add before we jump to what the betting market tells us about the U.S. economy?
Well, I just think it's interesting. We'll need to keep an eye on the Fed policy, because obviously interest rates have a huge impact on many areas. And if we do see the Fed start to return to their policy of cutting rates, that could really be supportive of the stock market, and could benefit other interest rate sensitive industries such as financials, home builders, et cetera. So with the strong rebound that we've seen in the stock market, this could add some additional positive news that maybe keeps this momentum going.
All right. Well, let's dive into what the betting market tells us about the U.S. economy. Financial markets tend to be very good at allocating capital supplied by investors to the companies and other entities that will use it most effectively to increase wealth and create long-term economic growth. But other markets can also be effective. And I don't recall us, we trickle it in there, but really focusing on betting markets. So what really is the betting market, and how does this maybe differ from any of the other sectors that we talk about?
Yeah, so any type of market is really based on wisdom of the crowds, where the combined information from all participants manifests itself into a set price. And usually that's a pretty accurate price if it's a large enough market and it works efficiently. And so, therefore markets, especially when people are putting up real money, right, meaning they have real skin in the game, can often be a very valuable predictor and can be very hard to beat, at least in the short term. And we've seen that, we've talked about that with the stock market, right? The stock market on a day-to-day basis comes up with a very good estimate price of the value of a given company. It's very hard to day trade, short-term trends and beat that, because, no one person or group of people are likely to have more information or more accurate information in total than the group as a whole. Mm. And I contrast this with survey data. There's a lot of surveys that we use, and those have become less and less accurate. And you could argue maybe that falls in line with a lot of the things we've seen with political polling, right? Where we've gone through a number of elections where everyone's shocked afterwards and says, oh my gosh, the polls were way off. And, there's a couple of problems there. One, if not enough people participate, you're not getting in an accurate, representation. Or if only, people with certain views participate and others don't, obviously you're not getting the full market, the full beliefs of the people that you're trying to to pull. And then the other thing is you have no skin in the game with the survey, right? There's no actual money. So a lot of people have started looking more and more at the betting markets, and that's something that we've used to some extent to replace the surveys, or at least to supplement them to say, okay, what are we seeing here? So one is a great example is Polymarket, where it's been very accurate at predicting results, and it even has different props where you can go in and look at like economic, political, financial data, things that investors would be concerned about, and see what's the percentage likelihood of a given event that's being priced in with real people putting up real money, and kind of give you an idea of what's likely to occur in the future.
Yeah, I've never heard of Polymarket until reading this version of the Personal Financial Review. I wasn't even aware of its existence, but I definitely found it interesting from a psychographic standpoint, like you mentioned, as someone that worked in an industry that we depended on ratings and stuff. People, it's when you're being asked by another person, you might say the thing that they think they want to hear or the easiest thing. So it's interesting when it comes to this situation because it's directly connected to the money.
Right. Yeah. Yeah. And that's the beauty of it. And it was used or really cited a lot around the election because of it. It was so accurate. And so when you see real efficient markets like this, it's at least worth taking into account. And what I think is interesting is we talked about the survey data has been really poor. The quantifiable economic data has held up fairly well. And what's interesting is, the betting markets, the poly market data is more on the positive side. I mean, as an example, we just mentioned that the Federal Reserve held interest rates steady. Well, in, at the beginning of June, the poly market was pricing in just a 3% probability that the Fed would cut interest rates. So clearly, it nailed that. But it's pricing in a 74% probability that the Fed will cut rates at least once in 2025. So, kind of what we were making the argument for. Clearly, the betting markets are behind that. Other things, looking at long-term interest rates probabilities, saying that there's just a 5% probability that the 10-year government bond will reach 5% in 2025. So one of the risks we talked about in the last podcast about the treasury markets, the treasury auctions, not going well and interest rates spiking. Well, clearly the betting market's saying that that's probably done. That risk has run its course. Only 5% probability that we'll see some type of higher move. So that's a positive. At the time we put this together, it was pricing in only a 26% probability that the U.S. will enter a recession in 2025. So that's good. The expectation for inflation is fairly low when you look at the betting market. So yeah, we're seeing a lot of positivity priced into these markets, whereas the survey data has been very negative. But at least for the last decade or so, I'd say the betting markets have been far more accurate, so they've been a better tool.
Yeah, it's a pretty interesting method for sure, and it was neat to become aware of it. Anything else you want to add before we jump into the American Opportunity Tax Credit?
Well, they did have priced in that the chances of the Indiana Pacers winning the NBA championship was only 15% on Polymarket. And I thought, if I was a betting man, I would have taken that one. They took it all the way to game 7. Halliburton got hurt and they lost. So once again, the betting market was correct. Although that was one that maybe was a lot closer than people expected.
Yeah, absolutely. All right, let's dive in. The American Opportunity Tax Credit is an income tax credit for qualified college or university education expenses for the first 4 years of higher education per dependent. So what is happening there? What are some of the maximum credits, not only annually, but over the lifetime of those 4 years? And what is even the claiming process?
Right. Yeah. If you're like me, you're spending the summer starting to kind of look at your finances and figure out how you're going to pay for a college student, right? Those expenses. And so this is just kind of an annual reminder of what is really a very generous credit, where it's $2,500 per year per eligible student, and you can claim it for up to 4 years. So it's $10,000. And that's a tax credit, right? Not a deduction. So a credit is dollar for dollar reducing your taxes. And even actually, a portion of this credit is refundable. So even if it takes your tax owed to zero, you'll still can claim a portion of it as a refund. So it's a pretty attractive credit. And if you have multiple children, 10,000 times each one, that can really add up. Here's the downside. To claim the full credit, taxpayers have to have a modified adjusted gross income. So that's your basically adjusted gross income is basically all of your income. Then you add in a few other things. You add back tax exempt interest, any non-taxable portion of Social Security benefits, a few other tiny little items to get the modified adjusted gross income. They use that because it's a little bit harder to, get your income below that level, by using like tax exempt bonds or something like that instead. For a single taxpayer, their modified adjusted gross income has to be below 80,000. For those married filing joint, it has to be below 160,000 to claim the full credit. And if you're single and your modified adjusted gross income exceeds 90, or married and exceeds 180,000, then the credit is fully phased out. So you're not able to claim it.
Mm. As always, comes with a certain amount of constraints. So, what is it when it comes to proper tax planning around this that people need to make sure that they're looking at, or maybe some of those different vehicles that would be an option that maybe could get the individual or married couple down to those markers?
Yeah, so let's say you're close, right? And if you can, bring your modified adjusted gross income down, you'd qualify for this pretty attractive tax credit. I mean, the first place to go is things like 401k deferral, right? If the money goes into a 401k, doesn't show up on the tax return, doesn't go into the equation. For federal taxes, you can also use health savings accounts, and since this is a federal credit, that would work. In some cases, there may be other types of retirement accounts that people could be eligible for, or even something like a deferred comp plan where they're able to allocate larger amounts of money to get their income down where they would qualify for the credit. So if people aren't sure, they're close. It can make a big difference on your final tax return, whether you get that $2,500 subtracted off of what you owe or not. And, a relatively small amount of income, $20,000 can be the difference between a full credit and no credit. So taking some time to look at that and see if there's anything you can do during the year to make sure you're taking advantage of every opportunity can be really valuable, because generally, for the most part, if you wait until after the end of the year, there's not going to be a lot of flexibility. It'd probably be difficult to find a way to bring the income down and benefit from that credit.
Yeah, absolutely. Anything else you want to add before we jump on over to the Plan Solutions Incorporated Office Bulletin Board?
Well, I would just remind people this is just one way of planning to pay for college, right? I mean, there's a number of other tax and financial tips, so it's probably part of a broader discussion. And if it's something that people are thinking about, I think it's definitely worth talking to a professional that knows a lot of these tips and tricks, that could help to cut down the out-of-pocket cost of what is usually a pretty big bill.
Yes, sir. All right. Well, let's jump on over to the bulletin board. It's that time again. Get your golf spikes out, get your golf glove ready, and start swinging at the driving range, because the golf tournament's just around the corner.
Yep. Yeah. We're going to soon be sending out the registration forms. So we're letting everyone know, make sure to mark your calendar. This year, the Harlan D. Wood and Debbie Dravenga Memorial Cancer Charity Golf Tournament will be Friday, October 10th. Once again, at the Rancho Marietta Country Club, we're playing the North Course this year at 1 o'clock shotgun. So hopefully we get, good weather as we have the last few years. Hasn't been too hot, hasn't rained. So we're hoping we can continue that good streak. And we'll all, head out to the holes and start at 1 p.m. with the dinner at 5:30. And of course, we'll have the silent auction and giveaways and all the other fun stuff that we've had in the past, with all of the profits going to cancer research and education.
Yeah, and then and again, if you're not a golfer, it's great to even attend and bring friends and enjoy the dinner and the auction. The whole Plan Solutions team always gets some amazing things donated that are pretty fun to pick up, with it all going to a good cause. I mean, there's been so much fun had over the course of the golf tournament. And again, even if you're not a golfer, it's fun to attend the dinner, fellowship, and enjoy.
Yeah, and I think the most important thing is if you're just kind of a novice golfer or you just play, then this is the tournament for you, right? This is not one of those where we take it really seriously and try and stack the teams, and everybody's going out there wanting to shoot a really low round and play fast. It's going to be a long, slower round, and play at a good pace for someone who's maybe just learning the game or just wants to get out and kind of try it out and enjoy themselves. We target more being all inclusive as opposed to targeting that high skill set.
Yeah. So this is the tournament, even though we started playing golf together around, I think, 16. This is still the tournament for me. So.
Right. Yeah. Compared to, a lot of other golf tournaments that can get pretty competitive, this is one where you'd still have a good time.
Yes, sir. And all the details are in the podcast description if you want to find out more. And of course, always reach out to the Plan Solutions team. Mr. Armour, anything else you'd like to add?
Just hope everyone has a great 4th of July. Great, safe, happy, no fireworks incidents, no bad sunburns. But yeah, hope everyone has a good holiday.
Likewise, and we thank you for listening or watching on the YouTube channel. That's right, Plan Solutions has a YouTube channel. It's simple to find. Just put in Plan Solutions in the search on YouTube. Or, of course, if this is your first time, also hit that subscribe button. Maybe you're on Apple Podcasts, Spotify. Not only subscribe or follow the podcast, but leave us a rating and a review. And please, we don't do any advertising of the podcast externally of the newsletter. So, hey, share it with someone else. That's how we continue to see growth, and we appreciate you for listening. And if you want to get subscribed to the Personal Financial Review, the written content we discuss, make sure to send Katie an email and get subscribed today. It's KATIE@plansolutions.com.
The views and opinions expressed in this podcast should not be construed as an offer to buy or sell any securities. The information may not be current, and Plan Solutions has no obligation to provide an updates or changes. Plan Solutions does not make any representation or warranty as to the accuracy or completeness of the statements or any information contained in this podcast or any liability therefore, including in respect of direct, indirect, or consequential loss or damage, is expressly disclaimed. Plan Solutions is not providing any financial, economic, legal, accounting, or tax advice in this podcast. In addition, the receipt of this podcast by any listener is not to be taken as constituting the giving of investment advice by any Plan Solutions associate or individual to that listener, nor to constitute such person a client of Plan Solutions. Any reference to a specific company or security does not constitute a recommendation to buy, sell, hold, or directly invest in the company or its securities. Market indexes are unmanaged and cannot be invested in directly. All price references and market forecasts correspond to the date of this podcast.
Plan Solutions is a registered investment advisory firm.